The cryptocurrency market is going through a little bit of a downtrend right now. Now, obviously, this has happened before. We expect it will happen again. This time, the vultures really seem to be out in force. They smell blood, and they seem ready to pounce on their prey. Really, with the market in red, and by these vultures, I'm referring to outside influencers, and they're working with a single focused intent to continue to drive the prices further down. The financial institutions, the media, the industry experts have ramped up their FUD campaigns, spreading misinformation, creating more uncertainty in the market. As much as they try, though, the digital asset space is extremely resilient, and it will rebound as it has time and time again for the past 9 years. This is the one area, the one thing that the financial institutions and the media have overlooked is really the fact that this space has gone through these ebbs and flows in the pricing for really since the time of the inception of Bitcoin back in 2009. Hi, this is Jeff with the HODL Report. Join me on today's video as we take a look at the outside influencers who are purposely creating market uncertainty and attempting to drive prices further down. In understanding the outside influencers that are working against the digital asset space, we're actually going to take a look at two very important financial disasters. One which was the .com boom and bust, the other which was the subprime real estate boom and bust. And we want to look at the influencers that really led to the boom and the bust and the recovery of both of those spaces, and how there are some comparisons and some parallels between what the outside influencers did in those areas and what's happening in the cryptocurrency space. Now, if you enjoyed today's video, please remember to give a thumbs up, leave some comments, subscribe to the channel if you haven't done so already. And let's get started. Now, before I get into the video, one thing that I'd really like to start doing is actually promoting a new YouTube channel or a new YouTube video that either they're brand new to the space or something new that I've run into that I've enjoyed watching that I want to share with you. Today, I'd really like to recognize Pepe Ciccia, I believe it's pronounced. He does really an amazing job. He has some videos. He just got started recently, and it's kind of taking you of a tour to really see and hear the sights of Australia while talking about XRP outdoors. I really enjoyed watching the videos. I watched all of them yesterday. It's kind of like Anthony Bourdain meets Mad Money. So go check out his latest video. I'm going to put a link in the description. So now let's take a step back to the .com boom. Now, the mid to late 90s really was amazing. Money was being handed out like candy to companies. If all they did was just have the .com in their name, they are a web company, they got money. If they had a business plan, website, didn't matter, they got money. Companies were making millions overnight, and there were so many paper millionaires that were being generated. It was just outlandish. Then, really within a few short years, by 2001, a sudden collapse in the market occurred. Microsoft at that time just hit a high of $38 per share. This was in 2000. This after 10 years of run-ups from an initial price in 1987 of 10 cents. And then we see from 1993 to 2000, the Microsoft stock essentially was doubling in value every single year. Now, during that same time that the Microsoft stock was booming, the entire market was booming as well. Many of the companies we could look back on and we could say that they're overvalued. Many of them, it was very speculative, very high-risk investments, no product, no profits. They have an idea, and the idea that their product might be the next big thing to catch on if they ever do create the product. Now, companies with no product, no use case, were really destined to go out of business, and they did. Now, this is simply the way the free market operates. The market will eventually dictate the success or the failure of the companies and will weed them out. Now, at that same time, the large financial institutions had been pouring millions of dollars into the space. And for those companies that went IPO, the big institutions were pulling millions of dollars in profits out. Now, as the market began hitting all-time highs in 2000, the media and the industry experts began talking about a bubble, a narrative that many in the media and many industry experts really seem to relish in promoting. They like this idea of talking about a bubble, and I think we see similar parallels to what has happened in the crypto space. Now, maybe too many people at that time were simply making too much money. Maybe it was an attempt to start shaking out the weak hands by spreading a little bit of FUD and market uncertainty. Maybe they were trying to drive prices down so they could create another profit cycle for profit taking. By this point, really there were many regular people that were just making outlandish sums of money from their ideas, from investing. Many new entrepreneurs were entering the scene, and the space was developing faster than the financial institutions could really keep up with. Then in 2000, 2001, the U.S. government antitrust violations case against Microsoft, a case that had started back in 1994, claiming that Microsoft held a monopoly by adding their browser to the Windows operating system. Now, this was all coming to judgment in 2000, 2001. And it was really interesting timing because it was this one little pinprick of this antitrust violations case, this little pinprick that really set the entire dot-com boom into bust mode. Now, consider this. Beginning of 2000, Microsoft was at an all-time high of $38 per share. By the end of 2000, that price of the Microsoft stock dropped to $14 a share. Now, the bottom basically fell out of the market. So you're looking at a 2/3 of the price dropped out on Microsoft. That's a huge drop in price. Now, to some, you would think, hey, maybe this is the end of Microsoft. They just lost 2/3 of their stock value in 1 year. Now, as with the market as a whole, so by the end of 2001, though, it's interesting. So Microsoft drops, the entire market plummets. It looks like a big bubble burst. But then within a relatively short period of time, so I'd say by the end of 2001, we started to see some recovery. So with Microsoft, that recovery looked if we look at their stock, it was $21 a share 1 year in. So it's already up by $7. Now, over the next number of years from 2001 forward till today, we see some ups and downs in the marketplace. But really, it was a pinprick. So just a little pinprick going after Microsoft. But this was really more like a directed message to the dot-com industry as a whole that the government can and will go after even the largest among them, and the market was put on notice. And we see what happened when they went after Microsoft. So this case against Microsoft really brought significant attention to the entire market. There was really a general lack of confidence at that point, and the money began flowing away from the dot-coms. With the sudden sell-off, stock prices were tanking, and this is where we see the dot-com bust. Now, again, as I was just saying, so with the prices at all-time lows now, by the end of 2001, we see a short period of recovery, but the big institutions started to jump back in at the end of 2001, taking advantage of discounted stocks. Now, obviously, those companies that survived the shakeout, they had strong fundamentals. Basically, they had the overall staying power to stay in business. All of a sudden, now they get an inflow of investments and stock buying at that time. Now, does this sound familiar? So if we look at the booms, the busts, the ebbs and flows of the marketplace, the outside and the internal influences government regulations, institution manipulation, media FUD, everything that if we look at right now at the crypto market, we saw these outside influencers trying to impact the pricing. And we see inside influencers, what we just saw with the Bitcoin Cash fork and the Craig Wright, going after Bitcoin Cash and going after XRP and just all that. It's crazy. Yeah, I mean, this is all the FUD that's being spread. So it's not unique just to this space. And this is really the point that I'm trying to bring up with all of this. Now, as I mentioned, so at the end of 2001, the recovery started, and companies like Microsoft with strong technicals and products of value were the ones that came back. Now, 17 years later, if we look at the Microsoft stock, it hit an all-time high of $115. Now, the market didn't move overnight. It did start moving up, though. We see after a year it started trending up, but the overall long-term strategy is recovery and upward momentum. So that was Dotcom. Now let's move over to the subprime crisis in the real estate market, which is also incidentally the basis for a global financial collapse in 2008. Now, mortgage companies and banks had really been singled out as the primary instigators of this entire crash. However, the government and the government policies, industry regulations carry a significant part of the blame that led to this financial crash and led to all of the subprime mortgages being written in the first place. Now, the foundation of these subprime issues can be traced to the Jimmy Carter administration issuing policy that was really dictating that banks lend to those in the poor communities under the Community Reinvestment Act, which was signed by Congress in 1977. Now, what this act actually did, it opened up a brand new dynamic in lending, and really over the course of the years that from 1977 forward, and so we're going to go forward about 23 years, but it takes some time in the making. But this really opened up the door for more creative financing options, allowing people to buy properties that they couldn't afford. So this was the housing market, little by little, inched towards these new and more open types of lending practices, again, to those that couldn't afford it. Now, what the Carter administration had implemented at that time was to actually force banks to fund loans that were not viable for long-term stability. Now, the government policies actually attacked the banks that wouldn't agree to do that, pulling approvals for bank branch expansions, cutting approval for liquidity for these banks, and really as an act that was signed by Congress, it wasn't changed. And again, it influenced how the mortgage industry grew and developed over a period of 20 plus years. Now, from 2000 until about 2006, this is really where we see a huge spike in the real estate markets. So through the creative financing that was created at that time, there are a huge amount of loans being approved, and it really became a seller's market, and the prices were skyrocketing because money was so readily available. And in many cases, the houses were selling for more than the asking price, and even 20 to 30% above what the properties were being appraised for. And now, what did the government real estate assessors do at that point? As the markets were going up, they obviously responded and reacted, and they pushed the appraisal values of the properties higher, because taxes are based on the appraisal values. So if the local governments want more taxes, then the appraisal of the properties goes up. Now, as the real estate markets ran up in value, the financial institutions entered the scene. Many of them were looking for places to put their money on the heels of the dot-com boom and then the dot-com bust. So they needed to put their money in something. So the financial institutions actually began selling mortgage notes between banks and other financial institutions. They also packaged these notes neatly as derivatives, which were then sold by financial markets all around the world. So this is how the reach of our real estate market really impacted the world as a whole. And so these mortgages, they became an investment tool that the financial institutions were making huge returns with. So it wasn't just about the real estate. Now, by 2007, again, here we go. The industry experts and the media start talking about a real estate bubble, and they start pushing this narrative over and over and over again, really until it starts happening. Now, the pricing growth of the real estate market, pushed by the financial institutions, the creative lending, backed by government policy, was simply not sustainable. Growing numbers began to default on their mortgages that they couldn't afford to begin with. And these defaults actually had significant impact on the financial companies that were holding the notes. And so these are the same financial institutions that packaged the notes, and they were selling them off as investments. And it created a huge mess. Now, in 2008, this is really where we see everything kind of exploding at this point. The big banks were on the brink of failure and bankruptcy, and the government steps in, saves the big banks and the financial institutions. They start deciding which banks are going to survive, which banks aren't going to survive, and now we see big government bailout with tax dollars. So now they're saving an industry that was just ripe with problems. Now, involved at the highest levels of the subprime crisis were the government's own Fannie Mae and Freddie Mac. Both organizations, no strangers to creative accounting. You can look it up, fraud and violations. I'm putting a link in my in the description. It's a link right to the SEC.gov, and you can read a news article from 2011 and how many executives ended up getting brought to court for a lot of different things they shouldn't have been doing. 2008 was really a bust year for real estate. It was really after 8 solid years of rapid growth. Now, with 10 years of recovery in the economy and the real estate market slowly beginning to turn around, clawing its way back to recovery, 8 years of restrictive government policy brought slow improvements, stagnant economic growth, really brings us to about 2016. Then 2016 to 2018, we see a decrease in government regulation on the industry, and the economy has really been allowed to breathe and grow, and real estate prices are now finally beginning to hit all-time highs in most of the hard-hit areas. A net result of the financial implosion from 2008 was the creation of Bitcoin and the birth of a new financial asset class, altcoins, cryptocurrency, XRP, Bitcoin, Litecoin, you know the rest. Fast forward 10 years, so 2009 to 2018, so 9 years, 10 years, with a brand new asset class, new investors, the cryptocurrency market that was again born out of frustration with the financial turmoil of 2008, an entirely new technology paradigm as big as the advent of the internet, and really with bigger potential than the dot-com boom of the 90s. This time, the big institutions are late to the game. The financial institutions and the governments around the world have been busy really trying to make heads or tails from the rapid rise in popularity of this new technology of blockchain and the digital assets. For the first time, early adopters, individual investors are in the space way before the financial institutions and even before the government regulation is kicked in. the market and the decentralized nature of this new digital asset space has really put the government and the large financial institutions in somewhat of a backseat position, and they're really scrambling right now playing catch up. We're seeing immense pressure being leveraged by the large financial institutions through the media and industry experts, spreading more FUD, spreading more misinformation, while at the same time they're scrambling to establish their own base to get market dominance. So they don't know exactly, how to achieve that, but they're doing everything right now to push things in that direction. Now, these large financial institutions are definitely coming, and they're bringing huge investment dollars. Now, while they seek their leverage positions, so they still need to establish leverage in this marketplace, the FUD has really been ramped up in order to undermine market confidence. And with a decrease in overall market confidence, many of the weaker hands are being forced out of the market, selling off their positions, and we see large sell-offs right now. And with the large sell-offs, this is putting pressure on the price, and we're seeing prices across the board go down. Now, as I stated in the beginning, the outside influencers are pushing their campaign of misinformation. Right now is where you need strong hands and resilience. The crypto market has had its share of ups and downs. Each year, it has trended up significantly, and each year is pulled back. So no amount of FUD or misinformation should really push you into changing your position based on what you already know. Now, the most important lesson really to get out of all of this that I covered tonight is that even in the worst of times, the markets rebound. And when they do rebound, they typically rebound big. And with that, I'm going to wrap up tonight. Before I do, let me just put out a quick statement. I'm not a financial advisor. I'm not providing financial advice in any way. But if I am going to offer you any advice, then let it be this. Do your own research. Invest only what you can afford. Invest only what you can afford to lose. And don't buy or sell based on the FUD or FOMO that's spread online. With that, I definitely look forward to seeing you on my next video, and keep on hodling your crypto.